Hello and welcome to Finextra. I'm Thea George and I'm here with Vinod Bhaskaran of Misys. We're at the Thomson Reuters Summit and we're talking about FRTB. Vinod, thank you for joining me.
Thank you.
So what is FRTB and how does it change existing regulation?
The FRTB regulation, or the Fundamental Review of the Trading Book as it's called, was issued by the Basel Committee for Banking Supervision in January 2016. And what it intends to do is it intends to replace the current market risk regulatory capital framework from the current regulation of Basel 2.5. Now, the regulation is very complex, but it introduces three main changes to the market risk regulation. The first main change is it revises the boundary between the banking book and the trading book. So the regulation clearly defines what a trading book instrument is, and it also prevents arbitrage between the trading book and the banking book. The second change is the change to the standardized approach. So the standardized approach under Basel 2.5 will now be revised under FRTB. And the main change here is that it's sensitivities based and the sensitivities have to come from the front office. The third key change is the change to the internal model approach. And the change here is that we're going from a VAR approach to an expected shortfall approach. And also we are adding more liquidity horizon buckets as well. So different risk factors will be allocated to different liquidity horizon buckets. So those are the three key changes introduced by FRTB.
And what are the challenges for banks in complying with this regulation?
So as I mentioned before, FRTB is a very complex regulation, but we speak to several hundred clients who are impacted by FRTB, and the three main challenges that they see is, number one is the front to risk compliance challenge. So one of the reasons why FRTB is such a profoundly new regulation is because the days when risk could just independently compute the market risk capital are long gone. We now need a front to risk coherent approach. So the front to risk compliance is the most important challenge faced by our clients. The second important challenge is around the capital charge itself. So FRTB in general will increase the market risk capital charge for most banks, especially if they adopt a standardized approach. The third key challenge is around the operational complexity and the computation load itself. So especially for IMA banks, FRTB IMA might increase your computation load by up to 60 times the current regulation. So that's the third key challenge faced by many of our clients.
So how are banks addressing these challenges?
When we speak to banks, what they are telling us is that FRTB is only a regulation at the end of the day. So all vendor solutions will have adequate functionality to comply with the regulation itself. So they follow a different approach. So what they say is that we are following a compliance plus plus approach. So let me explain that. So compliance obviously is mandatory for the regulation. The plus plus refers to value that you get out of your FRTB solution beyond the deadline itself. So like I mentioned, the capital charge impact of FRTB is quite huge. So capital charge will go up. Therefore, banks need to find ways of optimizing their capital charge. So that's the value beyond the compliance deadline. And they're also looking for value beyond compliance itself, so value beyond FRTB. And what we mean by that is, banks have a huge budget for FRTB, especially the larger banks who have to adopt IMA. And what they are doing with this budget is using it as a trigger for transformation of the bank. So not merely using it for FRTB compliance, but fundamentally re-architecting the systems landscape to deliver value beyond compliance itself. So speaking to our clients, that's what they're looking for from an FRTB solution. One that delivers compliance, value beyond the compliance deadline of 2020, and value beyond FRTB itself.
Vinod, thank you.
Thank you.
And thank you for watching.